Welcome back to the What's Your More podcast. I'm your host, Quinton Harris. You're dialed in for episode 233. It's kind of amazing when we think about that. Then we had a big week. Obviously, Super Bowl is happening on Sunday. If you're listening to this episode on Monday, we're recording here Friday, the 7th. And if you're a Kansas City fan and you won, congratulations. If you're an Eagles fan, you won, congratulations. We don't know the outcome yet. But nonetheless, it's Jobs Week. Lots of stuff to talk about. This is a pivotal week. We've been talking about jobs over inflation. So this is kind of a preview of things to come. And so what does that mean? This is what we're going to see in the form of rate reductions from the Fed. So we're going to talk about possibilities. We're going to talk about lower interest rates. We're going to talk about the job market. What's it mean and why is it relevant? All of that and more in this episode of What's Your One More. All right, so welcome back. As we get started, it is obviously Super Bowl Sunday is coming up, and if you're listening to this, it's already passed. And I think of this like kind of a cool moment here. You know, growing up as a kid, obviously the Super Bowl was a big thing, and it still is a big thing. But some irony in the Super Bowl is my parents got me this video that like highlighted all of like the first, 15, I think it might have been 18 Super Bowls. But inside of there, it talked about the creation of the Super Bowl, and I thought this was timely. The Super Bowl was actually named after Lamar Hunt, who was the owner, ironically, of the Kansas City Chiefs. And he used to have one of these toy Super Balls that he would bounce around and that he had gotten for his children, and it became a popular toy and thus became the name of the Super Bowl. Thought that was pretty interesting. Most people don't know that for Super Sunday. There's kind of lead with that. So let's talk about Jobs Weeks, get in here and kind of, what that entails, what that means. We talk about falling interest rates. We talk about the Federal Reserve. We talk about the mindset. And ultimately, we talk about what does that mean for real estate? Clarity on this show for me is an absolute. I look at people that are first-time home buyers. And, the fact that the average first-time home buyer's age is at 38, that's just crazy to me. And you could market many different things and say, oh, it's interest rate, it's affordability, it's lack of inventory, income. It all goes on. But it really all comes down to jobs, right? Because if you can't afford the product because of the job and the monthly payment, then that's typically going to be an issue. Rates do impact that, and so do the price, but the income in the household is also very, very important. And that's why Jobs Weeks is so important, because we get many different readings that come through. We have a JOLTS report, which is a job opening and leave report that comes out. We get the ADP, which is like the payroll company. You're very familiar with them. They determine the private sector jobs. We'll talk a little bit about that. And then you have the ultimate, the BLS report, which I often refer to as the BS report on here because we know it has its major flaws. And inside of that is a household survey that gives us the unemployment rate. So major readings all come out this week. And the reason that's important is because the Federal Reserve has taken the stance that it's labor over inflation. I mean, you're going to see next week's inflation week. That's the start of it. We're going to see those numbers come down. Matter of fact, they're probably going to come down significantly because there's that shelter component that's been lagging for so long is starting to catch up, and some more real numbers are coming in the form of real rents. More real-time rents are going to start showing up and really bring that number down, and that's going to be a win. And so what we were hoping for, if you're on my side of the table and if you're a first-time home buyer, a homeowner that's locked in, we've been hoping for these rates to kind of get some relief. This week was kind of important because we've had some momentum going in out of this Fed meeting from the commentary from Powell we talked about last week, going into Jobs Week. And then we had some wins inside the job week, and we also had a mixed bag of reports that happened actually today with the BLS. But the reason I think this was a win is that the private sector, which is the ADP report, was followed by the JOLT report. And the JOLT report shows, in my opinion, something that really is telling that's going on. And so in the job openings report, what that means is postings open. How many jobs are available, right? And so if there's a lot of jobs available, people at that point will start evaluating, am I happy where I'm at in my current employer, and can I make more money to go to another employer? So when those openings are high, such as they were during, the parts of 21 and 22, people start evaluating, well, if my company's not going to pay me X because I want more income so I can afford more, I'm going to go to company Y. Well, during that time, the job openings was around 12.1 million. The reading that just came in is 7.3 million. So there's a significant difference there, meaning there's less job availability. So theoretically, when you see something like that, that means more people are staying at their current job because employers are not hiring for other positions that are not available. So when we look at jobs weeks, that's less creation of jobs. Typically, that's good for the bond market. Check. We're seeing a win there because the bond market says, "Whew, that's a tightening of the labor market. That's not a great sign." And that's what the Federal Reserve was warning about. So we kind of saw that come in, and that was a good thing. Then the ADP private sector came in, and it came in higher than expectations. And as you know, if you listen to the show, anything that comes in above expectations is not really great for the market. But the argument could be made. How many of these postings are double postings, right? So, and I think work from home makes that significantly more telling. For example, if I have a job that I'm posting for in Florida, but I allow you to work from home, I may post that job in Indiana, Tennessee, Texas. It doesn't matter because I'm going to post it all over in areas because people can work from home and do that job, but that's showing up as 4 postings that I would have just described. So there's some discrepancies in those numbers as well. And so it really wasn't too much of a shock to the market to see that. And then Thursday's jobless claims report came in, and it was higher than expected. Again, a win for the bond market. So the momentum's building to this BLS report we got today. And so the reason this one's important is because we get that big official unemployment number. And I think that that's important because we've been talking about the Federal Reserve and their mindset. And they said, hey, listen, if this thing gets to 4.3, it's currently at 4.1. We're concerned. 15 of the 19 members said we're concerned. Today was kind of a mixed bag because what we did was we had a number that came in that was way below expected. It was expected that these BLS, which is the non-farm payroll, came out and would have created 170,000 new jobs. It created 143,000, but there was a lot of adjustments in there. And one of the biggest ones in there was the monthly revisions prior to it. There was things added into this report that happened, I guess, in January when the Census Bureau numbers come out. And so one of the major things on this was the unemployment rate, which is a household survey, right? And on the household survey, it's exactly what it is. It's a calling of 60,000 people. It's a household survey about did they lose a job, did they get a job, and what does that look like? The other component on that is the actual labor force and the participation rate in the jobs created. But inside of this, they took new Census Bureau information and estimated that 2 million people entered the workforce. 2 million people entered the workforce, and then all of them got a job, which I thought was pretty interesting because I just explained the job opening situation, that's not technically, sound theory, right? So you're going to take 2 million people, dump them into the unemployment, and you're going to say, hey, all of them got a job. So that impacts the total labor force and it impacts the jobs. So it's actually stating that there were more jobs created than the labor force, thus bringing down the unemployment rate from 4.1 to 4.0. If some of the stuff we're talking about on the podcast interests you and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time and they have award-winning service. So check them out at loanpeoplejax.com. That's loanpeoplejax.com. So the household survey, the challenge with it is that it's clouded by this new census data. So for example, they're adding in this survey over 2 million people to the labor force due to immigration. And the larger number were counted as employed of that 2 million. So the challenge we have here is that the household survey showed that there's 2.23 million jobs created because they added all of those new findings into the month of January. And so when in fact, there weren't that many actual jobs created. And for anyone that will listen, I've said, I do not think the unemployment rate's really 4.1. I think it's more closer to like 4.4, 4.5. This really didn't help that argument, right? Because of these numbers that were dumped in there. And this is January's information showing up here in February. But the reality is they're saying the labor force increased by 2.197 million people. But again, the labor force and the actual jobs created don't match up. So because of that, you see a drop, right? But this is a false drop. It's a false narrative. What's going to happen is that this number is going to pop in the month coming up in the next reading because it's going to say, okay, we can't just keep adding things in there like this. This census doesn't happen again in February. It's a one-time thing. So I think that what you're going to see is this number go from 4 to like a 4.2 4.2, 4.3 in the next report. And I believe that is going to be just in time and just enough for the Federal Reserve to go, all right, that's what we didn't want to see as we go into this March Fed meeting. And again, there's a lot of things that can happen between now and then. Inflation is going to be on our side. We're going to see that. But I don't think inflation moves the needle nearly as much as we're going to see the new job numbers come out in the month of February. And it was also noted, I think this is important, in these job numbers, none of it included any of the job losses potentially in California from the California fires. None of those showed up in that number, and that was specifically stated in the BLS report. I thought that was very interesting that they kind of said, hey, we're not looking at that in these numbers right now. That's not in this data set, which means it's probably going to show up in the next data set. And so why is that employment number so big? Because we know labor over inflation. And if the labor market starts to deteriorate, we also know that if things start to go the wrong direction on the unemployment number, the Federal Reserve is going to react. You're going to start seeing cuts. You're going to start seeing cuts in this March meeting, which is a big win for us. But let's also not discount this. I think the BLS survey, it kind of has this upward skew, if you may. And I think this is important to understand. So think about this household survey, right? Anytime you survey somebody, number one, it's not 100% accurate. You're just kind of getting how they feel at that time, and are they willing to accurately participate? Are they even willing to participate? But what was interesting to me is this. Remember, that was 2 million immigrants that they're saying immigrants got jobs. So on this household survey of undocumented individuals, I want you to think about this, like undocumented, like how do they find those numbers? If they're undocumented individuals, like how do you account for that? And if you do, are they even going to say that they're not working? Like, are they even going to answer the phone? I mean, how do you document something how do you get information from someone that's undocumented? So that's another reason I question this particular survey and how it was done. It just doesn't seem to make a lot of logical sense, right? And so going through this, I think this number is going to get adjusted like it always does. But I think going into next month, we're going to see the real whammy, if you may, on this unemployment number, which is going to give us an opportunity to start seeing the Federal Reserve make some very favorable moves here. Now, going back to the beginning of the show here, if you're a first-time home buyer, right, or you're a homeowner that's sitting there and you're going, man, I've been locked in, I've been waiting, like, when is this going to hit? If you were to ask me like 6, 7, 8 months ago, I would say, hey, what we're going to get is like a stair step of interest rates. Like it's going to be a gradual step, right? I think we're preparing for something that may be more of like a jump. It's not a cliff, but a jump. I think you're going to actually sometimes when you're in a hurry as a kid, and you would want to go up the stairs quickly. You might not step on the one in front. It might skip one or skip two and try to go up there. I think that's what we're going to see happen here on the interest rate side of things. I don't think it's unreasonable to see a half point overnight happen on interest rates as we get into this March and April seasonality. And I think it's going to stay there. Remember from our original forecast, we said, hey, something with a 5 handle on it will show up in the late second quarter, third quarter of 2025. I think the stage is set. I think we couldn't have a better opportunity. I think you're seeing all the pieces fall into place here. I think the economy is absolutely poised and ready for those cuts. And I also think this is really important. At the end of the day, the last thing Powell said on that podium was, it is our stance to comply with executive orders and policies of the President of the United States. Well, that couldn't be any more clear to me. Executive orders say to get affordability more in line for home ownership. And the first way to do that is going to be lower interest rates. And so, I think we're starting to see what I thought would be some butting of the heads between the Trump administration and President Trump and Jerome Powell maybe start to work together a little faster than I thought. And there's a lot of reason to think that that's going to start happening in the month of March. And there's a lot of pressure coming down the pipeline. You're also seeing the U.S. Treasury Secretary Bessent make some critical key points in making the actual bond market more favorable for interest rates as well. It'll be very interesting to see these pieces of the puzzle come together here, because I'm venture to say when we start talking about this in late March, we start talking about this in April, my oh my, how the economy could look different, especially on the mortgage side of things and the real estate ownership side of things. So for those that have been waiting, get poised, get prepared. For those that are in this lock-in, start determining what your strike rate is. Like that's something we talk about all the time. And lenders use this as a selling term, but I'm using it as a term inside of your house to talk about, like, if you absolutely know that your rate, they're like, hey, I'm comfortable if it gets down to 6.5, 6.25, 5.875, like lock that into your lender's head and say, listen, when it hits here, lock me in or call me. Like, let's go from there. Set the tone for that, because there could be a chance, history tells us back in 22 and 23, we got to rates and they stayed there for all of, 2 days, then they left, right? So maybe we see that again, even though I think it'll be more of, again, it'll be a jump and I think it'll be maintained. But there are going to be windows of opportunities to take advantage of this. And something else that I think is really relevant here, as inventory continues to stay depleted, it's not at high levels that it needs to be at. There will be a time as that inventory upticks because of seasonality alone. And as we showed in our 2025 forecast, anytime you're coming out of an election cycle, the seasonality is amplified. The peaks are higher and the valleys are lower. Well, we're coming out of the valley and the peak is on the rise. By March, we could be seeing the mid of that peak, and June would be the height, meaning the amount of transactions that are closed during that time. And what you want to do as a person looking to buy a home is you want to be on the front end of that peak. You do not want to be at the peak. You do not want to be competing when so many people are in the market space trying to get a home with a limited amount of inventory. You want to get in front of that curve. So take this time as an opportunity to plan for that and take this time to prepare, because once that first rate cut comes out from the Federal Reserve, that's when we're going to start seeing the musical chairs of properties happen again. And it won't be, but it'll feel a lot like late 21 because people will be competing for the same amount of homes that we're currently not getting right now. But all it takes is a little bit of rate movement and people are going to get off the sidelines, and it could be a rush. Plus, combine that with tax return season, people will have more money for down payments, cash on the sidelines. It all makes for a perfect recipe if you're looking to be a homeowner. And if you're looking to sell, you could get more for your home during that time than you would, let's say, later on in the year. So it could be a flurry of real estate, and it could be a great opportunity if you're looking to buy a home. Take advantage of that. Look forward to it on this rate cut that's coming up here in March. All right, guys, if you like what you're hearing, please 5-star review this podcast. Check us out on our YouTube channel at What's Your One More. That's at What's Your One More with the number 1. We put all of our charts and graphs in there. Big shout out to Brad over in Burbank, California, man. Spoke with you the other day on the phone. Appreciate all the feedback you're giving us on the podcast and listening to us and talking about how you appreciate what we're doing. You listen to it on the way into work when we drop them every Monday and Wednesday. So thank you very much. Love that kind of feedback. Love the comments on YouTube as well. We hear what you're saying. We work towards it, and we're trying to get more stuff out there for you guys to have at your disposal. Guys, till the next time, we'll see you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.